Hello everyone, welcome back to my channel. Like I said in the previous video that we looked at the course description of the venture capital management series for this semester, would also be looking at our first topic, and the first topic talks about the concept of venture capital management. I will just take us through what venture capital is, or venture capital is, then also talk briefly on equity, private equity, then advantages, disadvantages, characteristics, and some of the little things we need to know about venture capital. If you have not subscribed, don't forget to press on the subscribe button. Then also don't forget to turn on your notification button so that you know when we upload a new video. I say good afternoon everyone, welcome back to my channel. So today we'll look at what venture capital is, or venture capital is. The owners of the money invested into startup are called venture capitalists. The money invested is called venture capital. The idea behind it is called venture capital. So what then is venture capital? Like I said earlier on, that venture capitalists, or venture capital rather, is a form of financing given to startup companies or small businesses that are seen as having the potential to generate high rate of growth above the average, and there is a high rate of return, maybe now or later. Like I said, or I repeat, I'm about to repeat what I said, that venture capitalists are financing, or venture capital is financing given to startup companies or small businesses that are seen to have potentials to generate high rates of growth that is above average returns over a period of time. And this is usually generated through innovation or by craving out a new industry niche. Last semester we talked about the red ocean strategy and the blue ocean strategy. So creating a new industry niche is talking about the blue ocean strategy, something that is novel, something that has not happened. Even if it has happened, maybe you are doing it in a different way that is unique from what has happened before. So most venture capitalists are looking out for those novel ideas. They are looking out for those things that they are hardly in existence. Even though if they are in existence, they are looking for a different ways or a better way to improve that, maybe that service or that product, or that would make them to have a high rate of return over a period of time. Then the funding, where does it come from? The venture capital funding usually comes from investment bank, then specialized venture capital funds, maybe endowment trust, maybe pension funds, maybe insurance company, or sometimes wealthy individuals or wealthy investors. The people who invest this money are called venture capitalists. The idea is venture capitalists, that is the financing of startup or small businesses. There's also something very important that we need to know, that venture capitalist investment is also referred to as risk capital or patient risk capital. And why do we call it patient risk capital or risk capital? Because it is not all the time, or it is not always, that the funds invested into startup businesses is not always that it turns out well or it comes out well. There are many venture capitalist businesses, or venture capital businesses that didn't turn out well, and we didn't know it didn't turn out well because we did not get to hear the names of those organizations that failed. But if you go on Google, there are lots and many of these organizations that have been funded by venture capitalists that is no longer in existence. Some stayed between maybe the first 2, 3, 4, 5 years, and later they went into extinction. But some others did not even make it to the first year or the second year at all. Then the same way we have the ones that have failed, we have lots and dozens of organizations that were funded by venture capital that are still in existence and are still successful. Then what then is private equity? Like I said, there is a lot of similarities between private equity and venture capital, but they are not the same. You cannot use them interchangeably. They are not the same. Private equity is unique in its own way, and as it is, like we said, for venture capitalists, they fund only what startup businesses. They fund only what startup or small businesses. For private equity, what they do is equity shares representing ownership of or an interest in an entity that is not listed or traded on the Nigerian or any other stock exchange. What do I mean? For private equity, they fund more of matured or already established organization, unlike the venture capital that focuses only on startup businesses. The private equity funds organization or firms or products or services that are already matured, most times that are already established, and maybe they come to their rescue maybe because they are not doing well or they are not making the profits they are supposed to make, or sometimes maybe mismanagement, embezzlement, or it could be other reasons that are beyond this point. And what do? I said this investment buy shares. Sometimes they buy the shares of private companies or gain control of public companies with the intention of taking them to making them private and ultimately delisting them from the public stock exchange. I also say private equity firms mostly buy matured companies that are already established. They invest their money into matured companies that are already established. That is the main difference between a venture capital and a private equity firm. Then another point is how to become a venture capitalist. How do you become a venture capitalist? I have lots of points here, but I'm just going to tell us the ones that are germane so that I can make this video as short as I can. I said venture capitalists typically comes from institutional investors and high network individuals, and is pulled together by dedicated investment firm. It means that a venture capitalist is not somebody that is wealthy and is trying to finance a startup business. I feel that definition will come under the category of angel investor than venture capitalists. Something very germane. They pull the resources together by dedicated investment firms. So all these people that have money, or all these organizations that have money, they come under the umbrella of venture capitalists. They don't single-handedly most times finance those businesses. They pull resources together, and that is a form of syndication. That's the form of they bringing all their money together under an investment firm. Then that is that firm that comes out as a cover to finance the startup business. I also said it is the money provided by an outside investor to finance a new growing or troubled business. But most times venture capital or venture capital finance is into startup businesses, new, small or startup business. Then I said also venture capitalists provides the funding knowing that there is a significant risk associated with the company's future profit and cash flow. Then lastly, so that my slide will not be too long, that venture capitalist is the most suitable option, is one of the most suitable option for funding, is one of the most suitable options for funding. I won't go beyond that point. Then also, what are the futures of venture capital investment? One, like I said earlier, they target startup businesses, they target small scale businesses, they target companies that are just starting up, companies that they are not even in the public yet. Maybe the person have done one or two research and is looking for fund to take that business to the next level. Most importantly, venture capitalist focuses on this kind of business. That is one of their features. One, they also look out for high risk business, because the higher the risk, the higher the profit. The higher the risk involved, the higher the profit. Another feature of the venture capital investment is that they look for companies or startups that have high potential for growth. They have high potential for growth, and most of these companies, technological companies, cyber related companies, they have a geometric growth rate compared to an arithmetic growth rate. They have a geometric growth rate. Then also it is a long time horizon. It takes a long time for all these dreams to come into a reality. One of the articles I read on venture capital, it takes between 7 to 10 years and sometimes more. Then another important feature of the venture capital investment is that equity participation and capital gain. What do we mean by equity? Win-win, equal rights, win-win. We have a stake. They are providing finance to have a stake or to have a right in that business. Then I also said venture capital investment are made in innovative projects. I've said that earlier on, that projects that have high risk, projects that have high potential for growth, projects that are innovative, that are novel, that are new in nature. Then also suppliers of venture capitalists participate in the management of the company. They participate in the management of the company. Then another thing is, what are the methods of venture capital financing? There are lots of methods, but I just mentioned three basically here. I mentioned equity, and everybody knows equity from the word equality. Equity means I'm giving you a stake. You are financing my business to have a stake in my business, a stake in my business in return for cash investment. I said it involves selling a stake in your business in return for cash involvement. Is not like loan. Equity finance does not carry you still pay back in the future, but not that I'm getting a loan and I'm paying back at the end of every month. No, that is not what equity financing. Then another one is debentures. Another one is debenture. I said methods of venture capital financing. One is equity, another one is debenture. And what is debenture? Debenture is a type of debt issued by government or corporation that lacks collateral, and therefore it is dependent on the credibility and reputation of the person involved, or the organization, the individual or the organization or the corporation involved. The type of debt issued, the type of certificate issued by government or corporation. And it doesn't, when you get a debenture, you don't need a collateral. It's given strictly on your credibility or creditworthiness and reputation, maybe for the organization, for the service or the product, or for the individual involved. And the last one I'll be looking at is called conditional loans. Conditional loans. And conditional loans are not like the normal bank loans. No, conditional loans, they neither have a predetermined repayment schedule or any fixed interest rate on the borrowed capital. They don't have a predetermined repayment schedule, or nor do they have any fixed rate on the borrowed capital. And many big organizations goes for this kind of financing, either debentures or conditional loan or equity. So it varies. The one that pays any of these organizations the most is what they go for. Then another point is, what is the funding process? What is the funding process? What are the processes involved in funding? In the course of the semester, I would have to break some of these points into another video, but I'm just trying to give us a tip of the iceberg of everything we need to know in the course of the venture management class. And like I said, what are the processes involved, or the funding process. The first process is called idea generation and the submission of the business plan. That's the first step. And what do we mean by idea generation? This is the initial step of approaching the venture capitalist. And it means that you have an idea in your head, you have something new or something novel, something like the blue ocean strategy, something that is not out yet, and you feel it has high risk, it has high potential for growth, it has high profits if it is properly done and well managed and organized, that it has all these features of the venture capital management that I've mentioned earlier. And you feel that and if I get somebody to fund this business, is not a bad idea. And that is what we call idea generation. You are bringing you are bringing all your ideas into a document. You are documenting everything that is on your head or the plan, and at the end of that idea generation, you develop a business plan. And business plan is the step-by-step process of or a blueprint of that idea in your head, because it cannot be in your head and get funding. It cannot be just in your head. It's only you that knows what you want to do and you want to get funding. Nobody will put money into that kind of business. For everybody that wants to invest in they need a blueprint of the step-by-step process, of the step-by-step method of what you want to do. Sometimes they even go to the extent of saying, what have you done? How much have you invested in this business yourself? There are a lot of TV series that does that. I can't remember their names now, but I think the Lion's Den, and one other TV series that did something like that. So they want to know that before I'm investing into your business, or the venture capitalist is investing into a startup, they want to know, what have you done? Where is your business plan? What have you executed? How much have you invested in your own self? What stage of the business life cycle have you got into? And I said quickly, the plan should include the following points. It's not limited to this, but these are important germane points for your plan, for your business plan to also sell. You just don't submit business plan. There are key things. There are like if you are making a soup now, there are things you put in the soup for you to make the soup to be sweet. Like, you are making a soup and salt is not added. Man, that's 0/10. You are making a soup. You want to make a foriro. You want to cook vegetable, and you don't have iru. Iru is locust beans. You don't have maggi, Niger pot. You don't even have the leaf. You don't have crayfish. You don't have dry fish. You don't have pomo or meat. Please, how do you want to cook the vegetables? They are just jara. And these are the jaras for the business plan, the important elements of the business plan. For every business plan, it must include an executive summary. And what do we mean by the executive summary? It's just for somebody writing, an example is somebody writing a project, an abstract. An abstract summarizes all the important elements of the project. The same way is the executive summary. It summarizes the important, or the germane, the key points of the business plan. Then you should also include your description of the opportunity and the market potential and size. Description of the opportunity and the market potential and size. Then you should also review the existing and expected competition or competitive scenarios. Existing and expected competitive scenarios. Then you should also have a detailed financial projection for at least 5 years. A detailed financial projection for at least 5 years. Then don't over project too. In the first 2 years, you are likely to just break even. Even sometimes you run at a loss in the first 2 years. It is maybe from the 3rd year or the 5th year you start making profit, or you start breaking even, depending on the kind of business you are investing in. So if you are giving us a financial projection, don't forget, you don't have to exaggerate the projections. Just do it moderately, please. Then you should also give us a detailed of the management of the company, who constitutes who are the people that constitute the company, who are the people that are coming together to head that company. That is also important. You know why? Because before I invest my money, or the venture capitalists invest their money, they want to see the hands of the people they are putting their millions of dollars or thousands of dollars into. They just don't want to put it in the hands of any riffraff that will embezzle and take all their money. So they want to be sure, and that is why the details of the management of the company should also be included. Then lastly, a detailed analysis must be done before you submit the plan. I said by the venture capitalists to decide whether to take up the project or not. This step 2, before we go to the step 2, it means you have scaled through step 1. That is when you get to step 2. If the venture capitalists decide not to take your project, you won't get to this step 2, or not to take your business plan rather, you will not get to step 2. But if the venture capitalists decide to take up your own business plan from the millions and thousands of people who have submitted business plan for them to fund their startup business, then thank you, Lord. Then you move to this step, to this next step, and the next step is what? Step 2. And this is usually called startup or introductory meeting. And this is I said once the preliminary study is done by the venture capitalists and they find the project as per their preference, they will call you for a one-on-one meeting that is called, and it is called to discuss the project in details. They call you for one-on-one minute to discuss. They want to ask you some questions. They want to ask you, how far have you gone? Have you done any research? Do you have a prototype of this product or service that you want to render? What have you test run? What have you done? They want to know how far you have gone with the work or with the project or the services you are about to seek financial support for. And I said after the meeting, the venture capitalists finally decide whether or not to move forward to the next stage. It is if you pass this second stage, then you also have the opportunity to move to the third stage. In the university system, there's something we call prerequisites. Prerequisite means that there are 2 courses. If you have not passed 1, you can't do 2. One is a prerequisite to 2. So if you have not passed physics 1, please, how do you want to do physics 2? You have not passed statistics 1. I don't know if they still use it in the university system, but during my own days, I know they use it, prerequisites. And if you have not done 1, there is no way you can do 2 or 3 or 4, whichever. So once you pass this second stage, the startup or the introductory meeting, the next stage is called due diligence. And what we mean by due diligence is a proper research into that project or services. And it comes in different form for different organizations. Sometimes it could be queries related to customers, references. They want to know the kind of customers, the target customers that you have in mind. What percentage are you willing, are you likely to take from the total percentage of the market? They also want to know the product and the business strategy evaluation. Due diligence may be due to management interview and other such exchanges of information during this period of time. Due diligence is touche de coco. It means a digger deep into that business or product or services they are about to seek fund for. It's not fair. They are not just going to look at it from the tip. They want to know these are the funds of people who have come together through an investment firm to invest in your business. So it is not 1, it is not 2, it is not 3, it is not 4 people or organizations that have come. Sometimes even if it's not people, it could be endowment funds, it could be pension, it could be insurance. These are still people that are not visible in quotes, but if anything goes wrong, those people will come after you. So they want to dig down to know if it's proper for them to invest in that kind of business or not to invest in that kind of business. The 4th step, once you pass the 3rd step, the 4th step is term sheet and funding, and it is when the due diligence phase is satisfactory that you move on to the term sheet. And what is a term sheet? Is a non-binding document explaining the basic terms and conditions of the investment agreement. And the term sheet is generally negotiable, and all parties involved must agree, after which, on the completion of the legal document and legal due diligence, funds are made available. It is after the fourth stage that the funds are made available. What are the advantages of venture capital? One, they bring wealth and expertise to the company. Then large sum of equity finance can also be provided. The business does not stand the obligation to repay the money immediately. Then, in addition to capital, it provides valuable information, resources, technical assistance to make the business a great success, or to make the business successful. But for everything that has an advantage also has what a disadvantage. For on the part of the investors, or on the part of the, as the investor becomes like a part owner, the autonomy and control of the founder is lost. It might not be completely lost, but it is lost. Then it is a lengthy and a complex process most times. Then it is also an uncertain form of financing. Then the last one, benefits from such financing can be realized in the long run only. It has a long term. It doesn't have a short term. Then I also quickly highlighted some of the differences between venture capitalist and private equity. Like I said, most times people confuse them to be the same thing. They are not the same thing. Even the type of company, the kind size of company they invest to differs, is different. The type and the size of company they invest to. For venture capitalists, they invest strictly on startup business. Then for private equity, they invest on already established business. That is, the size, the type, the money invested into that business differs, or is different. Then secondly, private equity firm mostly buy matured company that are already established. Venture capitalists only invest into startup businesses that have high potential for growth, or high growth potential. Then thirdly, private equity firms mostly buy 100% ownership, but venture capitalists invest maybe 50% or less than 50% into a company. Then also, private equity firms can buy companies from any industry. They can buy company from, but venture capitalists are limited to technology, biotechnology, and maybe any technology related company. But private equity, they invest their money into any kind of business. Then private equity also can be both cash and debt investment, but venture capital firm deals only with equity investment. I hope I've been able to I've been able not to confuse and be able to convince you that what venture capitalist is all about. In our next presentation, we'll look at the history. Then we also look at edge financing, the classification like I explained in the course outline. We look at step by step throughout the course of the semester. I hope you enjoyed this series 1 or the topic 1. Please put in your comment in the comment section below. Thank you so much for watching. God bless you. Have a blessed day.